Every system that collapses believed it was different. That confidence is the pattern. Florence. 1494. The Medici Bank controlled European finance for 7 decades. It funded popes. It financed wars. It moved currency across kingdoms like blood through veins. Then it vanished in 18 months. Not from war. Not from plague. From something quieter. From the same mistake empires make when they stop counting the cost of their own confidence. The Medici fell because they believed their reputation was collateral. They lent to monarchs who never repaid. They opened branches they couldn't supervise. They confused influence with solvency. When King Edward IV of England defaulted in 1478, the damage was hidden. When Charles the Bold of Burgundy died in debt in 1477, the books were quietly adjusted. By 1494, the bank's liquidity was a fiction. Florence didn't see it coming. The Medici themselves didn't see it coming. The collapse was invisible until it was total. That invisibility is pattern 1. The debt that breaks you accumulates in silence. Rome. 3rd century AD. The empire stretched from Britain to Mesopotamia. It commanded 50 million people. It built roads that still exist. But by 235 AD, the Roman currency had become a lie. The silver denarius, once 95% pure, was debased to 5% by the reign of Gallienus. Soldiers were paid in coins that bought less every month. Inflation didn't arrive suddenly, it crept across decades. The empire responded by minting more coins with less silver. The cycle fed itself. By 301 AD, Emperor Diocletian issued the edict on maximum prices, freezing costs by law. It failed within a year. You cannot legislate trust back into money. Pattern 2. When currency loses meaning, the system doesn't collapse, it hollows out first. Rome didn't fall in a day. It fell in stages. The debasement was stage 1. The soldier revolts were stage 2. The fracture into east and west was stage 3. Each stage felt survivable. That's the trick of slow collapse. It never announces itself. Weimar Germany, 1921 to 1923. The Treaty of Versailles demanded reparations. Germany owed 130 billion gold marks. The government didn't have it. So it printed money. Not recklessly at first. Not with malice. It printed to survive. By 1922, inflation was visible. By 1923, it was apocalyptic. A loaf of bread cost 200 billion marks in November of that year. Workers were paid twice a day because currency lost value by the hour. Families burned money for heat because it was cheaper than buying firewood. The middle class evaporated. Savings became ash. This wasn't unique to Weimar. Hungary, 1946. The pence suffered the worst hyperinflation in recorded history. Prices doubled every 15 hours at the peak. Zimbabwe, 2008. The Zimbabwean dollar required trillion-dollar notes for groceries. The mechanism is always the same. A government prints to escape a debt it can't pay. The printing creates inflation. Inflation forces more printing. The currency dies. Pattern 3. Printing money is not a solution. It's a countdown. But inflation alone doesn't kill systems. It's what inflation reveals. In Weimar, hyperinflation exposed the fragility of social contracts. When money failed, trust in government collapsed. The Nazi Party vote share went from 3% in 1928 to 37% by 1932. Desperation doesn't build stable societies. It builds strong men. That desperation follows a rhythm. First comes denial. The Bank of England, 1797. Britain had funded wars against France for 4 years. Gold reserves were depleted. The bank suspended gold convertibility. The pound became a fiat currency overnight. The government promised it was temporary. It lasted 24 years. Denial bought time. It didn't buy solvency. Then comes rationalization. The South Sea Bubble, 1720. The South Sea Company took over Britain's national debt in exchange for exclusive trading rights. The company's stock price rose from £128 in January to over £1,000 by August. Isaac Newton invested. He lost £20,000. He later said, I can calculate the motion of heavenly bodies, but not the madness of people. The bubble wasn't driven by profit. It was driven by the belief that this time was different. The company had government backing. That made it feel safe. It wasn't. Pattern 4. Rationalization extends collapses. It doesn't prevent them. The South Sea bubble burst in September 1720. Thousands were ruined. Parliament investigated, executives were jailed. But the system didn't change, because the mistake wasn't in the company. It was in the belief that debt plus optimism equals wealth. Confidence becomes currency when the real thing runs out. That's what happened in Lebanon 2019. For decades, Lebanon's banks offered interest rates far above global norms. 15% on dollar deposits, 18% on some accounts. The rates were impossible to sustain without new deposits. The system was a Ponzi scheme in formal dress. By October 2019, the scheme broke. Banks froze accounts. The Lebanese pound lost 90% of its value. People couldn't access their own money. Protests erupted. The government fell. The collapse was predictable. Economists warned for years. But the system relied on the belief that warnings were exaggerations. That confidence delayed the collapse. It didn't stop it. Pattern 5. Systems fail when they run out of people willing to believe the lie. That belief is social infrastructure. When it cracks, everything cracks. Athens, 1893. Greece had borrowed heavily to modernize infrastructure. Projects, naval expansion. The debt was manageable while creditors believed Greece would repay. In 1893, they stopped believing. Greece defaulted, the drachma plummeted. The country entered a depression. Prime Minister Charalaos Trikoupis declared, regretfully, "We are bankrupt." The honesty didn't help. The damage was done. Greece defaulted again in 1932, and again after the 2008 financial crisis. Repetition is its own pattern. Which brings us to the 7th pattern. Collapse doesn't teach what you think it does. The United States, 2008. Lehman Brothers filed for bankruptcy on September 15th. $600 billion in assets vanished. The global financial system seized. Credit froze. Unemployment doubled. The crisis began in subprime mortgages, loans given to borrowers who couldn't repay. Those loans were bundled into securities. Those securities were rated as safe. Banks traded them globally. When housing prices fell, the securities became worthless. The system had built a skyscraper on sand. But the crisis wasn't new. Japan, 1992. The asset price bubble collapsed. Real estate values fell 70%. Banks held trillions in bad loans. The economy stagnated for 2 decades. The lost decades, they called it. Spain, 1557. King Philip II defaulted on state debt. The Spanish economy collapsed. The empire never fully recovered. The mechanisms change. Mortgages, real estate, sovereign bonds. The pattern stays the same. Leverage amplifies confidence until confidence breaks. No one in 2008 thought it would happen. Bear Stearns executives sold stock in their own company while telling employees it was safe. Lehman Brothers CEO Richard Fuld collected nearly $500 million in compensation in the years before the collapse. Alan Greenspan, former Federal Reserve Chairman, admitted in testimony that his worldview had a flaw. He believed markets would self-regulate. They didn't. That confidence was the first crack. So where does that leave us now? Global debt hit $305 trillion in 2024. That is 335% of global GDP. Corporate debt in China exceeds 160% of GDP. The United States federal debt crossed $35 trillion. Japan's debt to GDP ratio sits above 250%. These are not sustainable numbers. They are inherited numbers. Debts passed forward on the assumption that future growth will outpace current borrowing. That assumption held for decades. It may not hold forever. The patterns are visible. Central banks printed trillions in response to the 2008 crisis. They printed trillions again during the COVID pandemic. Quantitative easing. They called it. The money entered the system. Asset prices inflated. Stocks real estate, bonds. The wealth gap widened. By 2023, the richest 1% held 45% of global wealth. The bottom 50% held less than 1%. Inequality at this scale isn't stable. History says so. Pattern 6. Wealth concentration precedes fracture. France, 1789. The revolution didn't start with ideas. It started with bread prices. The monarchy had spent itself into irrelevance. King Louis XVI inherited a debt crisis. He called the Estates General for the first time in 175 years. The third estate, representing commoners, broke away. The revolution followed. The pattern wasn't unique to France. The Russian Revolution, 1917. Wealth concentrated in the aristocracy. The Tsar ignored economic collapse. Inflation destroyed the ruble. The Bolsheviks rose. Revolutions don't start because people read theory. They start because the system stops delivering the basics, and systems today are delivering less. Median wages in the United States, adjusted for inflation, have barely moved since 1979. Housing costs in major cities have doubled as a percentage of income. Education debt exceeds $1.7 trillion. Healthcare costs consume 18% of GDP. These aren't abstractions. They're load-bearing walls. When too many walls crack, the structure tips.